In February 2026, while Bitcoin was crashing and every headline on crypto Twitter screamed that the cycle was dead, Raoul Pal, the founder of Real Vision and one of the most respected macro investors on the planet, posted something that most people dismissed as denial. He wrote, "The crypto cycle is not over. That is an alluring narrative trap reinforced by continued daily price declines." People laughed. Bitcoin was falling from 90,000 towards 60,000. The war with Iran had just begun. Oil was exploding. Markets were in free fall. Calling the bear market narrative a trap while the price was crashing seemed delusional. 2 months later, the data is telling a very different story. And if you understand what that data means, what happens next could be the single most important opportunity in Bitcoin since the FTX collapse. The Crypto Fear and Greed Index has now spent 46 consecutive days in extreme fear territory. 46 days. That is the longest unbroken streak of extreme fear since November 2022, when FTX collapsed and the entire crypto industry nearly died. On February 6th, the index hit 5 out of 100. That is the lowest reading since tracking began in 2018. Lower than the COVID crash. Lower than the Terra Luna collapse. Lower than FTX itself. The absolute floor of human panic in cryptocurrency. Right now, the index sits at 8. That is not fear. That is capitulation. That is an entire market of retail investors saying, "I give up. I am done. Crypto is over." And here is the part that should make every single person watching this sit up straight. While retail capitulated, institutional money did the exact opposite. In March alone, spot Bitcoin ETF funds absorbed $1.6 billion in net inflows. That reversed 4 straight months of outflows. The biggest single day was March 28th. BlackRock's IBIT fund pulled in $380 million in one session. On that exact same day, S&P 500 ETF lost $13.6 billion, and the SPDR Gold Trust lost $2.26 billion. Stop and think about that. On the same day that institutional investors yanked $13.6 billion out of stocks and $2.26 billion out of gold, they poured $380 million into Bitcoin. BlackRock's head of digital assets explained why. He said it was because of Bitcoin's emerging status as a non-correlated macro hedge during periods of equity and commodity stress. That is the world's largest asset manager, with $15 trillion under management, calling Bitcoin a safe haven. While the fear index reads 8. While retail investors are panic selling. Raoul Pal's narrative trap is playing out in real time. The narrative says crypto is dead. The money flows say institutions are loading up. If you are new to this channel, subscribe and hit the notification bell. We are tracking this divergence between fear and institutional action closer than anyone else. Now let me show you what happens every time fear reaches these levels, because the historical data on this is not just bullish. It is the single most reliable signal in Bitcoin's entire history. There have been exactly 3 periods when the fear index dropped into single digits and stayed in extreme fear for weeks. Every single one marked a generational bottom. March 2020, the COVID crash. Fear dropped to single digits. Bitcoin was trading below $5,000. Within 6 months, it rallied 133%. Within 2 years, it hit $69,000. That was over 1,000% from the fear bottom. November 2022, the FTX collapse. Fear sat at 12. Bitcoin was at $17,000. The recovery took longer. It took about a year to reach $40,000. But within 18 months, Bitcoin hit a new all-time high above $126,000. That was over 600% from the fear bottom. And now we are in the third occurrence. The index hit 5 on February 6th. It has been in extreme fear for 46 straight days. Bitcoin bottomed near 60,000 and is now trading around 68,000. The pattern has a 100% hit rate. Every time. No exceptions. The question is whether this time follows the same path, or whether something has structurally broken. This is exactly where Raoul Pal's framework becomes critical. Pal does not look at fear indicators or sentiment charts. He looks at one thing: liquidity. At a global macro investor masterclass in September 2025, Powell laid out his thesis in the clearest terms he has ever used. He said that this is the 12 months where maximum money printing comes. The biggest macro variable of all time is that global governments and central banks are increasing liquidity to manage debt at 8% a year. He then added something that now sounds prophetic. He said that the correlation between Bitcoin and global liquidity is 90%. It is hard to refute that this is not what is happening. If liquidity drives 90% of Bitcoin's price, then the question is not what the fear index says. The question is what is happening to global liquidity. And the answer right now is that every condition for a massive liquidity expansion is falling into place. The global economy is staring at a $9 to $10 trillion debt refinancing wall in 2026. Central banks have no choice but to expand liquidity to avoid a systemic collapse. On top of that, the Iran war has cost governments billions in defense spending, oil shock mitigation, and emergency measures. That spending has to be financed. It gets financed by printing money. It always does. At an earlier appearance on the Wealthy On podcast in 2024, Pal explained this dynamic with brutal clarity. He said that in 2008, central banks discovered the money printer. The money printer is essentially debasing the currency by printing more currency. Now it is dressed up in a nice term called liquidity. He then added that we are exchanging a debt crisis for a slow debt crisis. The slow debt crisis is the printing of money. That is the cycle that has driven Bitcoin from $0 to $126,000 over 15 years. Governments accumulate debt. Crises force them to print money to service that debt. The money supply expands. The purchasing power of the dollar shrinks. And scarce assets like Bitcoin absorb the overflow. COVID proved it. Trillions printed. Bitcoin went from under $10,000 to over $126,000. The Iraq War proved it. The War on Terror proved it. And the Iran War is about to prove it again. Now, if you are getting value from this, hit the like button and share this video with someone who is frozen on the sidelines right now. They need to see this data before they make a decision they cannot take back. Let me walk you through what happened this week that ties everything together. Trump said yesterday that the United States will be finished with the Iran war within 2 to 3 weeks. The moment those words hit, markets moved. Asian stocks rallied 4%. S&P futures jumped. Oil pulled back. Bitcoin pushed above $68,000. If the war winds down, the chain reaction is clear. Oil comes down. Inflation fears ease. The Federal Reserve gets room to signal cuts. Risk appetite returns. And the liquidity wave that Powell has been forecasting, the one driven by the debt refinancing wall, kicks in without a war headwind blocking it. But even without a quick war resolution, the institutional behavior is telling you everything you need to know. BlackRock bought $380 million worth of Bitcoin on a single day, while pulling billions of dollars out of stocks and gold. ETF inflows totaled $1.6 billion in March, while the fear index sat in single digits. Bitcoin just snapped its 5-month losing streak. It was the first green monthly candle since August 2025. This is not what bear markets look like. Bear markets do not feature the world's largest asset manager increasing exposure while retail capitulates. Bear markets do not feature $1.6 billion in institutional inflows during the longest fear streak since FTX. At the SUI Basecamp conference in May 2025, Powell explained exactly why moments like this create the biggest opportunities. He said, "They don't want the system to break. Every time something happens, they inject more liquidity. They're giving you free money. And to take that money, you need the volatility." That is what is happening right now. Volatility is the mechanism. The fear is the fuel. And the people who understand Powell's framework are the ones buying while everyone else runs. Now, I have to be honest about the risks because this is not a one-way bet, and anyone telling you it is either does not understand the data or is lying to you. The green candle in March was modest, about 2%. Bitcoin is still well below its 50-day and 200-day moving averages. The broader technical picture is bearish. April is loaded with catalysts that could push prices in either direction. The March jobs report drops April 3rd. FOMC minutes from the March meeting come out April 8th. The Beige Book hits April 15th, and the next full Fed meeting is April 28th and 29th. Any sign that higher energy costs are driving inflation hotter will make rate cuts even less likely. Strategy also broke its 13-week buying streak. For the first time since late December, Saylor's company did not file a new Bitcoin purchase. With over 762,000 Bitcoin at an average cost of $75,000, they are roughly $7 billion underwater. Even the most committed buyer on Earth paused. Galaxy Digital's head of research, Alex Thorne, put it plainly. He said 2026 is too chaotic to predict. Risk remains to the downside in the near term. So here is the honest picture. Short term, the next 4 weeks are a minefield. The war could re-escalate. Oil could spike again. The Fed data could come in hot. The recovery is fragile and unconfirmed. But medium to long term, the setup has never looked like this in Bitcoin's history. 46 days of extreme fear, the longest since FTX. An index reading of 8. Institutions buying $1.6 billion in a single month while retail panics. Bitcoin printing its first green month in 6 months. A potential war resolution within weeks. And a liquidity cycle that Raoul Pal says is the most powerful in the history of modern finance, about to hit. In February, Pal called the bear market narrative a trap. The institutions bought $1.6 billion worth of Bitcoin in March, while that trap was sprung around everyone else. In September, he predicted maximum money printing was coming. A war that costs trillions is now guaranteeing it. The fear index is at 8. The pattern says what comes next. The liquidity framework says what comes next. The institutional flows say what comes next. The only question is whether you are on the right side of the trade when it happens. If this changed how you see this moment, subscribe, like, and tell us in the comments. Is this the biggest buying opportunity since FTX, or are we heading lower? We read every comment. We will see you in the next one.